Hey everybody, I'm Jono and welcome to Trading with Master Jack. In this video we're going to be looking at multiple time frame analysis. What is multiple time frame analysis? It is the process of analyzing market direction and momentum from a higher time frame down to a lower time frame, where you then identify possible entry opportunities to take a position long or short. The higher time frame shows overall trend, and the lower time frames can show possible entry points in a pullback in the favorable direction of the market. Gives you a bigger picture on your trade buys in a trading week or day. It significantly increases your probability of having a winning trade set up. Now, just a pre-introduction to put this into perspective: price is not linear. The market price action is not linear, and we're going to give you a perspective of this with a weekly, daily, and a 4-hour chart. I'm using the lines just to illustrate price movement. You see here we've got it from November 2019 in November to July 2020. So we've got a good 8 months of chart here, and you can just see how straight the lines generally move. Almost looks linear, but to put it in perspective, we've got the daily chart here. Now you can see, in contrast, there's a lot of price movement every day here. And then to take this from the daily to the 4-hour, you can see there's even more price action along these lines in contrast. Now, just to illustrate it nicely in a bigger picture, we look at the weekly chart, going over to the daily chart and into the 4-hour chart. And that basically shows you how price moves from a higher time frame to a lower time frame. Now, keeping that in mind, we'll look at candlesticks 101. If you see 4 1-hour candlesticks, for example, they together would equal 1 4-hour candlestick. It's kind of mathematics in visual form. If you added all these together, you'll end up getting this 4-hour candlestick. So it's always good to keep this in perspective whenever you are analyzing charts. Okay, we're getting started with a weekly time frame on the British pound Australian dollar currency, and I'm using a 14 EMA and a 50 EMA and the 200 EMA. The 14 EMA is just for illustrative purposes. I generally stick with the 50 and the 200 moving averages, but some traders like to use a 14 or even the 20 period moving average. I'd like us to get a focus in over here. Each line here represents 1 week. So you'll remember, in terms of candlesticks, this would basically represent 5 daily candlesticks each. And the area of focus would be in this area. You'll see where the price had come above the 200 moving average, and had come down and found support over there. So that starts showing a very good picture for us. And naturally, you only see the intersection of the MACD occurs in this week, and that then gives us a trend bias of going bullish. Now I'd like us to focus on this particular week over here after 2 September. That's a Monday, and so we'll look at the next week over there. We'll just plot our resistance line here, and that we'll see in the next chart on the daily time frame chart. Here we go, and there's our resistance line, and that is where the MACD had intersected on the weekly. It shows it on the daily as well. It occurred on that day, which was the 13th of September. That is at the end of the second week, which is a Friday. The 6th of September is Friday for the week that started on the 2nd of September, and each day here is Friday for the week that ended from the Monday. So our area that we're focusing on is over there. You'll see there was a resistance line here originally that had broken through there and found support, which turned support there, and that is our area of value, would be along this support line here, which is actually on the 200 moving average on the daily time frame. So now I'd like us to zoom into the 4-hour time frame, and there you'll see is our area of value, still that resistance line we had on top there, and there you'll see where the MACD had intersected, was just before the 13th, over there, showing on the 4-hour time frame, and that's where the support was found. And then I'd actually like us to look at this particular area of interest. The 16th September was where the week had started, basically, on the Monday on the 16th. So then you'll have a look at the stochastic, for example, on the 4-hour. It is showing us at the beginning part here, a upward trend momentum. And you'll remember from my stochastic indicator video that in an uptrend, the stochastic indicator usually remains in the 50 to 100 zone in this area, and the pullback's coming down here, which can identify potential buying areas. Now we're going on to the 1-hour chart, and there you'll see at that particular time that we had on the 4-hour, the MACD then shows us nothing much happening there. There's no triggers or anything we can use there. In fact, that was back then where the weekly and the daily had intersected on the MACD and the 4-hour. That's where the intersection happened. But now at our point of interest on the 16th of September, MACD is not showing us anything really except that strong momentum is coming to an end over there. But you'll have a look down there. The stochastic has shown us a great pullback overall in the momentum. The momentum has come down, and now it is going to be going upward again. So that would, in a sense, be an ideal time to be looking to making an entry at an area of value, which that is our area of value. And then we just got our resistance line there. Now into a recap. The higher time frame shows overall trend bias, and the lower time frames can show possible entry points in a pullback in the favorable direction of the market. If you're using a MACD as a trend filter, ensure that your weekly and daily, or your daily and 4-hour time frames of the MACD lines confirm similar trend bias before going into a position on your lower time frame. So basically, if the weekly says bullish, the daily must also say bullish. If the daily says bullish, the 4-hour must say bullish. And the stochastic indicator can show great pullbacks in the 1-hour time frames, basically the entry time frame that you use in the trend to open a position in favor of the trend at an area value. Suggested time frames. Now you know there's no holy grail. You've got to test and see what works for you based on your trading style and your risk tolerance. But basically, using a factor of 4 to 6 is recommended. So for example, here on Forex, I use a weekly time frame to determine my trend bias, and then the daily time frame for my area value, and my entry is at the 4-hour. Or sometimes it's the daily and the area value is at the 4-hour, and the entry would be at the 1-hour. Now when I say a factor of 4 to 6, you'll see if you, for example, use the 4-hour, then your entry would be the 1-hour. So it's a factor of 4, 1, 4. Weekly to the daily, that would be a factor of 5. So yeah, and 1 hour, for example, if your 1 hour is at the area value, then 15-minute, that's a factor of 4, or you can even use the 10-minute as your entry. That would be a factor of 5. I'm sure you get the picture. Now remember to keep an open mind when doing multiple time frame analysis, so that you do not miss out on other important technical analysis opportunities, such as wedge formations, ascending and descending triangles, as discussed in the Trading Plan Part 1 video, and other chart patterns that you may favor within your trading plan. If you enjoyed this video, hit that like and subscribe button so that you don't miss out. Happy trading, and may the trend be with you.